Hello, everyone. Welcome back to another episode of Signal or Noise, episode 63. Charlie Bilello here. With me, as always, Peter Mallouk. Peter, one topic for today. This has been something I've been trying to get to the bottom of for the past few months, and I'm hoping you can help me through this here. And this is the question. It's a huge divergence. I'm calling it the Great Divergence. Why is consumer sentiment so low with stocks at all-time highs? And I'm just going to give you the backdrop. We've never seen a gap like this. And before we dig into some of the reasons, I want to show you this gap and get your take. What do you think is explaining this? And then I'll give you some of the reasons I think might be explaining this enormous gap. So first of all, here's the backdrop. We know S&P 500 having another great year, up 36 all-time highs this year. That follows 57 the prior year, up double digits once again, following two great years in 2023, 2024. The last 3 years, Peter, 84% gain for the S&P 500. That's 23% annualized. Very rare to see a 3-year period with stocks doing this well and being at all-time highs. And if we look at the University of Michigan's Consumer Sentiment Index, you would never know that that was the case. And this is historically unprecedented. So this goes back to the 1950s where they're asking consumers how they're feeling about things. And Peter, I'm showing you today 50.3. It's the second lowest reading in the survey's history. Only June 2022 when inflation spiked to a 40-year high and we were in the bear market for the S&P 500. That's the only time it was lower than that. And if you go back in history, the other times always been in a recession: 08, 09, 90, 91. 1980, we had two double dip recessions there in 1973, 75. And if we dig into some of the reasons, why are people so negative in terms of what's explaining the low sentiment? Well, they think that unemployment's going to rise. So we haven't seen it at this level since the financial crisis, where people expecting job losses to occur in the next year, and they're expecting inflation to rise as well. But my question to you, Peter, before I give you some of my potential explanations here, what do you think is explaining this record divide between the stock market and how consumers are feeling in general?
Well, I think there's a lot of things happening that make this a unique situation. One, we normally talk about consumers as just one big group of people, but what's really changed here is we've got two economies, we've got two groups of people experiencing very, very different things. If you were an asset holder, you own stocks, you own a private equity or a private business, you owned real estate, you came out of COVID, flood of money into the system. We saw high inflation. Well, if you're an asset owner, as most of our listeners are, that worked out fine for you because those assets inflated even at a higher rate than inflation. The private businesses, the real estate, private equity investments, stock market. But if you are a typical American and you have a salary and you don't have a lot of home equity, or you have no home equity, a very small amount in your 401k and nothing else, the cost of everything went way up. You don't have assets to offset it. And so, that's what we call the K-shaped recovery, right? There's a group that isn't feeling it, and there's a group that is feeling it. This is why you have the CEO of McDonald's at the latest earnings call saying our customers can't afford to come to McDonald's anymore. That didn't used to be the case. It used to be people that were going to Applebee's and Chili's went to McDonald's and so on. Now it's so tough that people are being pushed out even of the McDonald's level. Yet the same exact quarter, we're seeing luxury brands, luxury travel post record earnings. So there's a big part of consumer sentiment that's negative because of that, because a big part of consumer sentiment is most Americans that weren't asset holders. I think the other big component is just what you said. The market's had this epic 3-year run. People get that doesn't go on forever. So there's just this ominous feeling that a shoe is going to drop. I think 3, political tension isn't helpful here, right? It doesn't matter if you're on the left or the right. It's hard to turn on the TV and feel positive or not feel like the world in general is getting a little more uneasy and more dangerous. You hear that messaging coming in different ways from the left and the right. And then I think lastly, there's a lot of background noise about valuations and the level of valuations and correlating it to the tech bubble. So I think you put all those things together, you get this negative consumer sentiment. The positive news is I wrote about this in my first book. The University of Michigan Consumer Sentiment Survey is a great contrarian indicator. When people are terribly negative, the market tends to do really well.
Yeah, so you just hit on a number of my points here. So let's dig through those, including the whether it's still a contrarian indicator. So let's start with the big question: why the divergence, Peter? And you mentioned inflation. That has to be front and center. That seems to be the big difference here. I'm still a little bit confused by it because, of course, inflation was higher in the 1980s and late 1970s. So we saw it higher, but sentiment wasn't even that bad then. So it's not just inflation, but clearly this cumulative inflation that we've been talking about the last 5 years, it's not 2%, right? If we're looking at all these different categories, people are feeling this cumulative level. And even though the Fed's saying it's under control, it's 3% over the last year, people are not thinking about that 3%. They're thinking about all these price increases, aren't they?
That's exactly right. And I think the difference between now and the 70s is that interest rates were very different in the 70s. Here you can have very high inflation over the last 3 years, and bondholders were getting a few percent a year. I mean, it's very, very different, I think, comparison.
Okay. So in terms of digging into these prices increases, Peter, this is something you and I have touched on a lot, and we even did an episode, I think, about it. Maybe another one is due here. Health insurance premiums in the US. Huge issue for a lot of Americans here. We're talking about a 365% increase since 1999, going up and up and up. And then every single month, Peter, with that CPI report, we have to hear the government's calculation of this, which is actually showing, according to them, a decline in the cost of health insurance over the last 5 years. So, could part of it just be a measurement issue where people are feeling more inflation than what the government's actually reporting?
Oh, I think that's definitely part of it. I mean, the government reporting, I mean, really like over the last couple of years has really highlighted how we can't truly rely on what it means to be an American that is having a struggle with things like food, health insurance, car insurance, and you look at the government measurements versus what we know the reality is. It's clear that people are feeling it more than what's in the official numbers.
Yeah. Let's go to number two here. This is my belief, especially for the younger generations. And you and I did an episode on this recently in terms of how we could improve housing affordability. But lowest in history has to be a factor here for anybody under the age of 40. Recently, Peter, the median age of a first time home buyer actually hit 40. A decade ago, it was 31. And the big reason for that is a lack of affordability. 57% gap here I'm showing between the income you need to buy a home and people's actual income. So actual income is much lower than what you would need to qualify for a mortgage to buy the average home in the US. And if we look at the payment you would need, Peter, it would need to be 47% of your income if we include that property tax, insurance, everything else, all that into that monthly payment, highest level in history. How big of a factor do you think housing or the lack of affordability in housing is to the sentiment picture?
I think it's if it's not number one issue, it's the number two issue. I mean, people really look at their ability to live a quality life is can they afford to buy a home? And the barrier here has gotten so significant that there's no question that this is one of the primary reasons people are feeling the strain. This is, I mean, literally the definition of the American dream is the single family home, right? And so you make that difficult, you're basically saying you can't participate in the American dream.
Absolutely. At least it's being delayed for many, many Americans. Let's go to number three here. And this is something we've touched on a lot, but the stock market doesn't equal the average in American. More Americans own stocks than ever before. It's about 62%, according to this latest Gallup poll. So that's a good sign that it's going up, Peter. But we know that holdings aren't equivalent, even though 62% holds equities. It's not a significant portion of people's wealth for many people. So the fact that stock markets are at all-time high, that's a good thing. That's better than them being down a lot, of course, but it's not having the same impact across different income groups, different wealth groups. And we could see that within this sentiment index, they broke down the biggest stockholders versus non-stockholders, a sizable gap. Again, doesn't explain everything because even the biggest stockholders had relatively low sentiment, but a big gap there. And if we look at the income earners, this is a different sentiment poll. Higher income earners less impacted by that inflation picture. You could see a huge gap between over 100,000 in income and under 50,000 income. How important is this type of divide, do you think, to the sentiment picture?
I mean, this to me is one of the top reasons. This is a haves and haves nots world we're in right now at a level I don't know that we've ever seen. Now, a lot of people will counter that and say, "Oh, quality of life is better." That's 100% true. Like even families that are struggling. I mean, they have nice TVs, they have phones um, that have more computing power than Apollo 13 had. In the palm of their hand. They have air conditioning and heat usually, and all these things. Yes, the quality of life of people at the very, very bottom has gotten better. Unfortunately, that's not how humans think, and we look at the gap, and the gap is significant.
Okay, let's talk about number 4 here, profits versus personal experience. So if we're looking at, okay, S&P 500's hitting record highs, we're hearing about all these incredible earnings, Peter. We're almost done with the third quarter here. S&P earnings on pace to hit another record high, up 13% over the past year. And profit margins, if this holds, will be a new record high in terms of profit margins. And you contrast that with people's personal experiences. Is my income going up this much? Am I keeping up with higher prices? Am I anywhere near having a good of a time as the Magnificent Seven names? And the answer, almost universally for most people, is no. So that big disparity, I think, has to explain some of this as well.
Yeah, I agree. And I do think though, when you look at S&P 500 operating margins, there is a story behind it, which is that this there's a larger percentage of S&P 500 companies that are tech oriented than ever. They also happen to be the biggest companies, and tech companies happen to have wider profit margins. So there's always a story behind the story, but this is definitely a piece of it as well.
Okay, let's go to number 5. And you touched on this, Peter, but this is a confusing one for me because it changes right with every presidential election. And we could see that in the chart here, breaking down consumer sentiment between Republicans, Democrats, Independents. And you could see what happened in 2020. Republican sentiment started high, went down, and then in 2024 did the opposite. And Democrat sentiment went up after 2020 and down in the most recent level to really their lowest levels ever. So people talk about political polarization. I definitely think it's a factor, but obviously can't be the only factor. The other part has to be, Peter, media and social media, I would say, and just people becoming just more angry about the other side. And that's causing them to have lower sentiment, it seems to me, overall in general, regardless of whether their party's in power or not.
Yeah, I think there's a definite feeling on the left and the right that the world has gotten more dangerous. The country has gotten less stable. There are issues now that are not just fighting about things that I'm gonna call them little things, but we've moved to existential things. I think people really start to wonder what the country will be like down the road. The language around all of this has really changed, and it's hard to imagine this doesn't have some negative effect around the way we see the economy.
Yeah, and just in terms of if people want to improve their sentiment, I'd say if you get away from the arguing and fighting on social media or on network news, in terms of that's not really good for your mental well-being, Peter. And I think like just the increase obviously in social media over the last 10 years is skewing all of this stuff more to the negativity side because almost any issue, and even we're not posting political stuff, but if you post anything, it gets drawn into the political realm where people are fighting about the unemployment number today that came out, and the Republicans are arguing, well, it's not a real number. Democrats are showing it's going up, and every single data point, every single issue has become really a political fight pointing to the other party. And if you dig into that, I think that's going to really worsen your mood as a consumer and worsen just your mental health in general.
Yeah, that's right.
Okay, let's go to where do we go from here? Because this is the question, and this is what I'm trying to work out through this line of thinking. So it makes sense looking at those five different reasons. Okay, it makes sense. Consumer sentiment is low, maybe not near record lows. Still, I'm having a hard time understanding that. But here are some of my questions, Peter. I'm going to put them to you. Number one, how will this gap be closed? So is it the case that the consumer is just totally wrong here and they'll eventually improve their sentiment to catch up with the better stock market and economy that's still in an expansion? Or is it going to be the other way around? Which way, if you had to guess, do you think this is going to be closed?
I think the gap can be closed, but for it to be closed, we have to stop with $1 trillion a quarter deficit spending. We cannot close the gap with that kind of deficit spending because it's inflationary. I think second, supply and demand will help solve this problem. No one can buy a house. House prices are going to eventually have to come down. Now we got some policies on the horizon that might cause problems with that, but the gap can be closed with some very basic measures. Whether those will happen in the near future or not, left to be seen.
So let's jump to those before we go to and we could probably do a whole episode about them, but I want to get your take. I recently talked about it on my weekend chart show, but 50-year mortgages, $2,000 tariff dividends, these are both addressing in different ways that, or trying to address that lack of affordability question. Do you think these are the solutions to those problems?
Right. So I rarely take a position this firmly, but this is truly one of the worst policy ideas I've seen in a long, long time. What this is going to create is just a debtor class, and it's going to artificially inflate home prices. It's very inflationary. Our problem now is people cannot afford a home. What you need to let happen is for supply of homes to increase, the prices of homes to come down as there are less buyers until the supply and demand works itself out. If you create 50-year mortgages, immediately home prices go up because the monthly payment for every home has gotten easier to make with a 50-year mortgage. So you're just going to create, to me, this is like student loans. You create a class of people, you give them all these humongous loans, and then they get saddled with this debt. You make them debt slaves for the rest of their lives. This is absolutely a horrible idea, literally on every level. Nothing good about it. It would not turn out. It would not turn out well for the economy, for the working class, for the middle class. Wall Street will love it. You can package this stuff up and sell it to people and make their money and their fees and let other people deal with the consequences. But it looks like a gift to the working class and middle class, and it's really going to further the divide.
Yeah, 100% agree. I mean, it's really just taking the cause of the problem, which is artificially stimulating demand through the Federal Reserve's policies and other policies, and saying, well, I don't care about all of that. Let's just do more of the
Yeah,
same.
let's make
So
it
if you,
worse. Let's just do
let's
more of what caused the problem.
and we'll have the government backstop it, and we'll have people just not really owning anything. And after 10 years, if you look at the 50-year mortgage, you're actually only building 5% equity. So it's mostly going to interest payments. And yeah, sure, a bank would love that if the government's going to guarantee that mortgage and backstop it. Sure, they may like it and make profits off it, but not addressing the lack of affordability whatsoever. And the 2000 tariff dividend, Peter, same question. Is that going to help people with the inflation problem that they're feeling every single day?
I mean, obviously, same thing, political gimmick, and kind of just this. It shouldn't happen on any level. Corporate buyouts, private business forgivable loans, um, distribution checks. These things are inflationary. We need prices to come down. We need deficit spending to stop. That's the solution to the problem.
Yeah, if you have a $2 trillion deficit and you send out $2,000 tariff dividends to everyone, you're essentially borrowing more money to send it out to people, which is what we did back in 2020 and 2021. We know what will happen because we did it before. And
Right.
so if you want to see another inflationary spike, I can't think of a better way to do it than to do that policy. Unfortunately, it's only with a lag will people see the negative consequence of that. All right, let's just end here with the question, Peter, because this we've talked about this as a signal many times in the past. When consumer sentiment is bad, it's an inverse signal, and usually it's occurring with the stock market down. And here's the chart here. is it still a contrarian signal? We're in second lowest reading ever, so definitely in the lowest 5% of readings. Historically, if you look at what the stock market did over the next year, 18.7% gain versus the highest consumer sentiment readings, only a 4% gain. Is this still a contrarian signal, or is it broken for all of the reasons that we're talking about today? Which is essentially asking, Peter, does our consumer, is their negativity really a reflection of not just how they're feeling about the economy and spending, but is it that they're negative on stocks, and then if they were to become positive on stocks, that would push stocks higher? That's been why this has worked so well in the past. I'm not so sure this is still a great signal here. What's your take?
I agree with you, Charlie. I think we do a whole episode just on this, what's the same and what's different. I think the reasoning in the past was, well, if you're really negative sentiment, you're not in the market, which means the second anyone feels a little bit better, this money floods in the market, which is why the market goes up, and this is a contrarian indicator. I think, though, all the reasons we covered, I think it's a little bit different. I mean, the political climate, the social climate, the inflationary climate, all these things converging together. There's legitimate reasons combined with valuations. People feel this way. I would be pleasantly surprised if it's still a contrarian indicator and the market has this incredible tear and goes up 20% over the next year, which is what the historical norm is with something like this. But I would emphasize the word surprised.
Yeah, and you have to wonder, given we're at the second lowest reading ever, Peter, what would actually happen if the consumer is right here and unemployment goes up and inflation goes up over the next year? Where's this thing going to go?
Yeah. It'll break a record for negative.
We'll have to do another episode
Yeah.
at that point in time. Hopefully, that's not the case and the consumer is wrong. But just an interesting, fascinating disconnect here. We're trying to explain it, and I think some of the reasons are valid, but it's very hard to say because it's really a personal answer to a survey question for everyone. That's going to be different. All right. Great place to end it. If you're looking for a second look on your portfolio or your financial plan, talk to us before year end. Go to creativeplanning.com/Charlie. Get a free wealth path analysis from us at Creative Planning. We're located in all 50 states, so we likely have a location right near you. Over 390 billion in assets under management and advisement, and we're here to help. So reach out to us today. I'll have a link in the show notes. creativeplanning.com/Charlie. Thanks everyone for joining us on Signal or Noise. If you're watching this on YouTube, reminder, hit that subscribe button for all the latest content from us. And Peter and I will see you on the next episode of Signal or Noise.